Bloomberg Audio Studios. Podcasts, radio, news.
So now we're going to go to Cliff Asness, who's AQR Capital CIO with Bloomberg News global finance correspondent Sonali Bassak at Bloomberg Invest on Bloomberg Television.
Part of the program, has the market gone awry? And in addition to, of course, being a high-flying hedge fund in Greenwich, Connecticut, you're known at AQR for being quite nerdy, let's say. You are very much coming out of the school
Not just at AQR, since middle school.
So let's put it this way. Out of the School of University of Chicago, under Eugene Fama, studying efficient market theory, the question is, do you think the markets are still efficient?
I took Gene's class, and then I was the teaching assistant for 2 years. And I was terrified to get something wrong, so I sat through it for 3 years. About the third week of class, he looks and he tells the students, the market is almost certainly not perfectly efficient. And you get a big gasp. Now, only at the University of Chicago and only Gene's class do you get a gasp with that. Everywhere else in the world, people either go, yeah, we know markets aren't perfectly efficient, or they have no idea what you're talking about, which is often quite common. What he meant, he's an honest guy. He believes they're more efficient probably than I do now, but perfect efficiency is silly. Nothing is perfect. The question becomes, how efficient are they? I think it's fair to say someone like Gene thinks they're pretty darn efficient. Efficient is this idea that prices are accurately reflecting fundamentals. You can get really geeky on how to define that, but let's just be colloquial. I do have a view, it's not a short-term view, it's not a market call, that, again, markets are never perfectly efficient, but over my career, which is annoyingly about 32 years now, I guess the opposite would be even more annoying, but it's a long time. I'm a little obsessed these days with those internet memes of when they show you like an actor like Ed Asner and Mary Tyler Moore was 10 years younger than me when he did the role. It's very upsetting. But over my career, I actually think markets have gotten somewhat less efficient, meaning prices are a little bit more disconnected from reality. It ebbs and flows. It's never the same at each point in time. But I find that an odd view because one tends to think, as technology in particular advances, that things should march towards better, with better, I think, being efficiency in this case. And I actually think maybe I'm biased by having a front row seat, but I think over the last 30 or so years, I'd say the market is somewhat less efficient than when I started.
So why do you say that is? What is causing it to be that way?
It's, well, first I start out by just observing a few facts. And I am, of course, biased by what I've lived through, but I loved Gina's presentation. The dot-com bubble stuff was bringing, PTSD-like memories for me. We try to very formally measure how disconnected from reality or not, or how reasonable are stock prices, in particular, not the price of the whole market, but within the stock market, are cheap versus expensive stocks. You could define that very narrowly in a quant sense in terms of just multiples. You could define it more broadly in terms of a Graham and Dodd sense. Yeah, you want to pay a low multiple, but what's the quality of the stock? What's the risk of the stock? But either way, measured very formally, the dot-com bubble saw by far the largest disparity between cheap and expensive we had ever seen in about 50 years of data. We survived that. It was a little ugly for a while, but we actually thrived through it if you take the whole round trip. But when you almost die in the first half, you tend to remember that. If you had asked me in, say, 2002, when all of that excess was pretty much worked off, are you going to see something more extreme than that in your career? I think I'm smart enough, even back then, to never say never. We don't live in a business where any of us should say never. It's a dangerous word. But I think I would have said it's highly unlikely. That was the craziest thing we had seen in 50 years. I would have said, well, in 20 years, people like me will still be around, I hope, who with some memory. It's not 100 years where everyone is forgotten. And then pre-COVID, it was close. And then after COVID hitting, we saw things measured very similarly. price multiples or even price multiples scaled by quality to go to levels well beyond the tech bubble and lasting about doubly as long as the tech bubble. If you ever have the misfortune to have an investment that ever goes down for any amount of time, you will learn something that they don't teach you in a PhD program. Severity is bad, but duration is underrated when it comes to pain. 3 years of pain, even if it's cumulatively not worse than a year and a half of pain, is a ton worse. The first year you go back to your clients and go, we think we're right, look what's going on here. They go, okay. The second year they're like, that's the same thing you said a year ago. And you go, yeah, but it's still going on and we're still going to be right. The third year, your mom's still invested, but it's getting tougher. So duration counts. So we've seen both the severity and the duration of those. So I start out just observing facts. And then trying to fill in why. Admittedly, this is a lot of op-ed. This is very hard to prove. And I love to, I'm a card-carrying quant. I love to, produce tables. I can show you these spreads, but why? And I tend to I think it's a multitude of things. I think the number one thing is probably the thing we all love to blame, the internet and social media. I think a lot of people naturally assume such a thing would bring us information so quickly and so ubiquitously, knowing everything, that prices would be very efficient. But that's never been the hard part. When I started in this industry, we got earnings within 20 minutes. The difference between 20 minutes and a nanosecond matters to an HFT. It doesn't matter to almost every other investor. We didn't really materially get more. And I do think that level of information overload gives people a lot of illusion of control. I don't want to go into this deeply because I know you'd like to get me going on this, but I think the meme stock examples, I don't think they're the norm by any means, but I think they're the ultimate example of a little bit of information making you think you really know something very deeply. And I think that gets into market prices.
I'll be careful to keep this a little reined in, but on the meme stock issue.
I knew I'd get that started.
How much are the retail traders that are bidding up prices of stocks like GameStop contributing to this idea that markets are less efficient to you?
I think they are a very small part in dollars. They may be poster children in some sense for the effect. The whole idea that this disconnect in prices can come in a world where we have all the information at our fingertips. I think we're all raised, at some point we've all read about the, quote, wisdom of crowds, the way, if you take a crowd that on average people have 51% information, but you poll them. Hope many of us here are old enough to remember Regis Philbin and Who Wants to Be a Millionaire? The absolute best lifeline was always poll the crowd, right? Because if they asked a question, what does it say on the back of a quarter? 85% of the people don't know. But they're evenly split. And the 15% who do know all go one way. But there was always a little unspoken footnote to the wisdom of crowds. To have a wise crowd, it's got to be fairly independent. If everyone got to talk about the quarter, not look at a quarter, that's cheating, but talk about it, the people who are wrong convince the people who are right and whatnot. A crowd where everyone is coordinated and not independent has the risk of becoming a dangerous mob. And I don't know about you guys, but I can't think of anything better at turning a wise, independent crowd into a dangerous mob than the internet and social media. So I do think they're kind of the poster child. I don't think economically they are that important. I don't want to disparage either side of it, but it's $9 in terms of, NVIDIA laughs at that on a daily basis. The entire meme stock phenomenon is like a little part of a day of NVIDIA. But I think it is a poster child for the concept I'm talking about. There are other candidates. People talk about the role of passive. That's really complicated. I'm not one who just looks at passive and goes, that's causing all kinds of havoc.
What is it causing?
Okay, I'll disappoint you here. People, I don't think we really quite know yet. First of all, here are the things we know about passive. Not everyone can be passive. The whole world breaks down. Even back when I was a PhD student, so this is the early 90s, a kind of this is what happens when PhD students in finance get drunk late at night. They sit around going, what if everybody tried to be passive? And that's a black hole. That's a singularity in finance. Nobody's looking at individual stocks. And that just can't work. Passive is a free rider on active managers, making sure prices are somewhat reasonable. But the question of how many people can be passive, nobody really knows.
Do you think it's contributing to inefficiency? And is efficiency, frankly, another way of saying wild swings in markets?
I think I would guess yes, but I think it's pretty small versus the social media, the illusion of control, the data overload things I'm talking about. It's not clear theoretically. Imagine you had a world where you had a certain amount of passive and active, and suddenly a lot of active moved to passive. Whether active is now easier or harder, whether it's more or less efficient, depends on who moved. Let me be really obnoxious and go, there were sharks and minnows. There were people who were good at it and people who were bad. If all the minnows move, markets get really efficient because sharks are trading with sharks. They all are pretty good at valuing these things. And the sharks don't make a lot of money. We don't really know who moved. My reasoning here is really just correlation, not causation. This has occurred at the same time that massive price disparities have grown and lasted longer. So as a pure guess, I would have to go, it's probably contributed something. It's very hard to assign. Another one is, I'm probably the billionth person to mention this, but over the same period, we've had 10 years prior to a couple of years ago of ultra low nominal and real interest rates. I am not a person who thinks that means growth stocks should go to the moon. I've written papers on the math of that's kind of wrong. They're not actually that much longer duration. But the market disagrees with me. The market thinks when interest rates fall, growth stocks should go to the moon. And so ultra low interest rates have probably contributed to a fair amount of that also. So I think it's a witch's brew, but if I had to put the three, I think maybe I'm just an old man ranting at TikTok, but I think the feeling that you own all the information and are on a level playing field, and therefore you can own two stocks and be very confident about it.
All right, that was Cliff Asness, AQR Capital CIO, and Bloomberg Sonali Bassak at Bloomberg Invest.